You go to the bank and are asked if you want a debit card or a credit card. What's the difference and which one should you choose? This is the most common question for teens trying to learn how to manage their money. So I decided to find the answer by running the numbers on the fees, the interest, and the way each card affects your money to find out which one is better and the price you have to pay if you get it wrong. By the end of this video, you'll have a great understanding of the pros and cons of each, as well as an accurate look at the costs so you can decide for yourself. So what are these cards in the first place? Well, debit cards are cards that take money directly out of your own bank account. This means that if you don't have enough money in your account, you can't spend it. For that reason, debit cards are very commonly used by teenagers just starting out with managing their own money, as it feels like a safer choice since you can't accumulate debt, which is basically money you owe someone else that you have to pay back. However, debit cards don't come with the perks that a credit card does. Unlike debit, a credit card doesn't take money out of your own account. Instead, you're borrowing money from the bank and promising to pay it back later. This is where your credit score comes in. Every time you use a credit card and pay it off, you're proving to lenders, who are basically the banks or companies deciding whether to trust you with money, that you can be trusted. This increases a number called your credit score. A good credit score can get you lower interest rates on things like car loans, or can help you save on apartment rentals. But that borrowed money comes with a catch. If you don't pay it back in full, you get charged interest, an extra cost added on top of what you already owe, and that's where things can go wrong fast. So, how much can that interest actually cost you? The graph on screen represents two people spending the same $100 a month. The line in red is the person paying with debit, so it's simply gone. The line in blue is the person putting it on a credit card and only paying the minimum, which is just the smallest amount the bank requires you to pay that month. This creates a gap between the two. This gap keeps growing the longer they carry a balance, which is the amount of money they still owe by not paying off their bill fully. This causes interest to compound or build on top of itself, working against you instead of for you. That's the real cost of only paying the minimum. So, which card should you actually choose? The graph makes the credit card look risky, but that's only true if you carry a balance. Used the right way, credit is actually the better long-term move. This is because it's the only one that builds your credit score. The real answer isn't debit or credit, it's how you use it. If you pay your credit card off in full every single month, you get all of the benefits. This includes an increase in your credit score, as well as other rewards, like cash back on what you buy, or even points on special credit cards such as American Express cards that could earn you free plane tickets and other rewards. On the other hand, debit is safer if you're not ready for that responsibility yet. But if you can manage it, credit, paid off in full, is the smarter play. Compound interest working against you when you don't pay your credit card bills is scary, but it could also work in your favor. In fact, using compound interest is the key to growing your money exponentially. If you want to know exactly how much money you can make by taking advantage of compound interest, check out this video, where I look at what investing $5 a week will get you over different time periods, all the way up to 50 years. I'll see you there.